Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later on, we'll be speaking with Tom Corley. Tom Corley is a CPA, a CFP, and the president of Serifice & Company, CPAs, in New Jersey. But he's also a best-selling author. He wrote the best-selling book, Rich Habits, The Daily Success Habits of Wealthy Individuals. What do you know? In college, I would scoff at the possibility of any real-world application for the virtue talk in works by Aristotle and others like him. O callow youth. Mr. Corley speaks of little else. We at Financial Poise produce over 100 webinars a year on topics of interest to accredited investors, business owners, executives, and their professional advisors. To find those webinars, please go to www.financialpoisewebinars.com, which is also accessible from our gateway site, www.financialpoise.com. Well, recently we recorded a webinar called The Nuts and Bolts of Investing in Pre-IPO Shares, which is another way to refer to investing in private companies that one day might go public. This is part of a 9-part alternative investment basic series of 2015. In that particular installment, the panel of experts talked about the allure of an IPO. It means you can cash out, presumably, at a great profit from your pre-IPO investment. Then, how do you get to be a pre-IPO investor when you're a stranger to the founders? What opportunities are there to buy in? And what opportunities are there other than IPOs to sell? That is what we talked about in that webinar. Well, the initial public offering world has gotten smaller. Pre-IPO stage private tech companies are staying pre-IPO for longer, and in some cases, seemingly forever. The Wall Street Journal has written about this in a couple of articles I wanted to talk about with you. On October 16, 2015, in an article entitled IPO Investors Scale Down Risk, the authors discuss how there's increased market skepticism about issuers, that is, the tech companies, which are not very profitable or which are carrying heavy debt loads. Now, wait a minute. Why would anybody invest in a company that's not very profitable or which is carrying a heavy debt load? That seems counterintuitive, but it's not. We are in a world of scalability. A lot of tech companies tie their fate to the ability to reach customers or to deal with customers and solve customer problems or desires on the internet. And the internet has a very large number of people participating. There are 7.2 billion people in the world. 40% of them are connected at this point to the internet, or nearly 3 billion people. That's an immense market. Markets are simply bigger now for such things as these tech company startups would like to present to the world. So, if a private company has a heavy debt load or is not very profitable or both, that might not matter as much as the promise it has of delivering on taking advantage of that huge market. Maybe it has a great idea, maybe it has a great team, and so people do invest in such companies, and valuations go sky high, and that's a separate set of issues that have been taken up in recent articles throughout the press, that private companies have been overvalued. Too many $1 billion companies are really not worth that much. But in the October 16 article I was just talking about from the Wall Street Journal, the following data point is discussed. Throughout 2015, up until October 16th, IPOs raised $32 billion on 152 deals. That's a lot of money. That's a lot of deals, but the IPO market was much more active in 2014, $82 billion across 240 deals over the same period of time. So the IPO market has gone down seriously. Okay, on October 20th, 2015, the Wall Street Journal published a related article entitled, Tech Startups Start to Feel the IPO Chill. The IPO chill discussed in the October 16th article. As to the allure of scalability, the article says, and I quote, some venture capitalists and executives at startup companies are not worried. They say startups have never been cheaper to build and are maturing faster than fledgling companies did in the last tech boom, partly because the smartphone era creates an easily reachable market of 2 billion people, might even be bigger than that. So that's scalability. But it's more than just scalability. It is what economists would call low barriers to entry. So if there are low barriers to entry for the startup entrepreneur, it follows that there are low barriers of entry to the competitors to the startup entrepreneur. So even a great idea and a great little company that's really going to do well once it has sufficient capital, well, it's going to face competition and maybe even regulation to become big enough. The article points out that Lending Club Corp, an online lending marketplace, has seen its valuation shrink from $8.5 billion after its first day of trading, its IPO, in 2014, to $5.4 billion. That's a drop of 40%. The share price has just plummeted amid concern that competition and regulation threaten Lending Club's business model of matching borrowers with lenders. And now a word about Dropbox. If any of you have started an enterprise of your own or worked in a nonprofit in recent years, well, Dropbox at one point was the go-to for organizing emails and data files because they let you do it for free. They do have paying customers and hence do have a bottom line they are serving. However, as the article points out, online storage is fast becoming commoditized. And now I'm reading from a paragraph which continues, and Dropbox now competes with Apple, Google Inc., Microsoft Corp., and Amazon.com Inc., the world's 4 largest tech companies by stock market value. Low barriers to entry indeed. Now Dropbox finds that the collective powers of Mordor, Sauron, Voldemort, and the Soviet nuclear arsenal of the 1970s are all coming at them because there's money to be made and it's easy to do what it is Dropbox pioneered a short 8 years ago. So Dropbox is now trying to diversify what it does to maintain itself as an enduring business. It's a challenge. So scalability and low barriers to entry. So there are a couple of other factors, and I'm quoting from the article. More than 2/3 of venture cap-backed private companies in the U.S. valued at $1 billion or more are backed by a public market investor, such as a big mutual fund, hedge fund, or bank, according to Dow Jones Venture Source. All right, that introduces a new player. So you need capital while you're a private company, and a big player, an institutional investor, says, we'll give you the 50 million or 100 million you need, and we'll become investors in your late stage tech startup that's highly scalable and doing really well. Well, all right, but that introduces a new dynamic. It's not just the founders hoping to cash out. Now you have a hedge fund or a bank or maybe a pension fund, which have others to serve, who are really looking for that payoff when the IPO comes. They want that IPO sooner rather than later, probably. And, well, one last thing I'll read to you from the article. In a sign of wariness among pre-IPO investors, an analysis of funding rounds by law firm Fenwick & West LLP in March found that 30% of private companies valued at $1 billion or more promised a specified IPO price. Okay, so if you're a big investor, you have the market power to go and say, well, I'll give you $50 million to take this company to the next level, But when that IPO comes, we expect to be paid $100 per share on our investment, not 90, not 85, 100. And what happens if the IPO doesn't yield $100 per share? Well, the article says in some cases, the issuing companies agreed to give additional equity to investors if the IPO price was not met. Now, you're the large institutional investor. You want the company to pull the trigger on an IPO at a certain point. If you're the founder, you might be pretty nervous about doing that because the company you founded and the equity that you have, that you were counting on hitting a home run with, might be at risk. You might have to distribute some of that equity to the disappointed institutional investor. You know, they say there's no crying in baseball. Well, in pre-IPO tech investing, there's crying just as it really is in baseball. It's certainly not for the faint of heart. Let us turn now to virtue. Well, we're back, and we have with us here today Tom Corley, writer, speaker, researcher, accountant, among other things. Mr. Corley's youth presented him with experiences of highly varied fortunes within his own family. More recently, he spent 5 years observing and documenting some 200 daily activities of 233 wealthy people and 128 people living in poverty. Tom found great differences between the habits of the wealthy and the poor. These habits separated the haves from the have-nots. His research is distilled in his best-selling book, Rich Habits, The Daily Success Habits of Wealthy Individuals. Tom speaks and motivates audiences at industry conferences, corporate events, universities, and global sales organizations. Tom has also appeared on national and international network and cable television programs such as CBS Nightly News, Yahoo, Financially Fit TV, India TV, and News.com Australia, plus sonic appearances on nationally syndicated radio shows, including The Dave Ramsey Show, Marketplace Money, and WABC. Tom frequently contributes to Business Insider and Credit.com and has recently released his second book, Rich Kids, How to Raise Our Children to Be Happy and Successful in Life. Mr. Corley is also a CPA, CFP, holds a master's degree in taxation, is president of Serapis & Company CPAs, one of the top financial firms in New Jersey. Tom Corley, welcome to the show.
Oh, Chris, thanks for having me on your program. It's a real honor to be here.
You're certainly welcome. So, the rich, myth and fact. We've heard politicians refer to the wealthiest, formulaically and derisively, really, as millionaires and billionaires, who should be taxed more, that is, to pay for redistributive spending. And those who advocate such moves do not evidently think or consider that being taxed more, the wealthy would invest less, which would punish the non-wealthy with decreased opportunity. But maybe that's the wrong way to think about it. Remember, we're talking about myth and fact. Maybe it's not economic blindness that underlies the view of the millionaires and the billionaires, but that there is a premise that the wealthy use their dollars unproductively. John Maynard Keynes famously said that practical men who believe themselves to be quite exempt from any intellectual influence are usually the slaves of some defunct economist. Madmen in authority who hear voices in the air are distilling their frenzy from some academic scribbler of a few years back. So I guess what I want to suggest is that one of the academic scribblers might be Thorstein Veblen, whose 1899 book, Theory of the Leisure Class, introduced the concepts of conspicuous consumption and conspicuous leisure. So it's a picture of the wealthy using their wealth not for investment, but for display and status, as in pre-modern societies. Further, according to Veblen, the bad habits of the wealthy in spending so much on shiny objects to demonstrate their high status has also corrupted the poor, who copy the millionaires and billionaires to their detriment. So, that might be one of the myths. Mr. Corley, what are the facts?
Well, you know, Chris, the question I always ask when I'm confronted with that question is, does anybody think, given the history of our federal government and also the state governments, that they're going to do a better job spending your money by taxing you, if you're rich, than you would do. And Adam Smith came out with a great book. Really, he's the father of modern economic theory, The Wealth of Nations. And he was the first individual. They called them philosophers back then. They didn't call them economists. And he was the first real economist to make the case and argue that the money that wealthy people make actually is good for society because it's a sort of invisible hand way of directing people's interest, their self-interest, into doing things that are productive. What he was talking about is capitalism. And all you have to do, Chris, is look at what China's done over the last 20 years. In the last 10 years, China has lifted 350 million people, that's more than the population of the United States, from abject poverty into the middle class by simply embracing capitalist policies. So when you tax the wealthy too much, you're moving away from capitalism and more towards a socialist political system. And what that does is it simply takes money out of the hands of the people who are productive, who are making the economy grow, and you give it to the government. Does the government make the economy grow? And the answer really is not that much. There isn't a multiplier effect with the government spending like there is with the private sector spending. So that's a myth that the government should be taking more of the wealthy people's money through taxation and using it to redistribute to the poor people or even the middle class people to help with college tuition. That's where a big chunk of it is going right now.
Let me stop you there if I could. Just because you categorize that, or you pushed it along the dimension towards socialism, if people would look at the statesmen of the early 20th century, such as Woodrow Wilson in particular, who went under the progressive banner, the idea was, yes, the government could spend it better because we would have a technocratic elite of brilliant people, smart people, who knew what needed to be done to take the funds and apply them as they should be for the betterment of society and to break the undue influence over our lives by concentrations of wealth among the financially well-off. I just wanted to put that in there because has become part of the American tradition, not the founding tradition, but a later graft onto the American tradition. It's not so alien as socialism necessarily, I guess I would say. But I didn't want to throw you off.
I think the bigger issue is, let's not call it socialism, but just expanding government programs, because when they're able to take more tax dollars, an interesting thing happens. The government doesn't shrink; it grows. And the problem is, we just don't have a good historical evidence that the government is responsible with the money that they do collect. In fact, they're so irresponsible with spending that we've got an $18 trillion deficit. So I have a problem with putting more money into the hands of government. I would rather see it go back into the private sector. These people that are what I call American dream achievers, they'll know what to do with the money. They'll invest it, and they're always looking for more returns on their money. And so they're going to deploy their capital in a way that is in their own self-interest, but also happens to benefit society, in my opinion.
So what are the habits of the rich that are, not talking about the level of the economy now, but just the level of analysis here is rich people themselves and how they behave? The myth that I was talking about and that you were referring to, the premise underlying it is that the wealthy behave in a certain way, have certain habits, but you have found otherwise. So what is it about the wealthy?
And I have to tell you, Chris, I come to this issue, to this topic very objectively because I really had a negative opinion of the wealthy, and I wrote an article about it, which is, part of what we're talking about here. Everything you've been led to believe about the rich is a myth. And I came to some conclusions after my study that were opposite of what my beliefs were about the wealthy. One of the things that I just assumed was that rich people inherited their money, that most of the wealthy people are wealthy because of generational wealth. And as it turns out, that's false. And it's not only in my study where I found that 82% of the wealthy didn't inherit anything, but PNC comes out with these annual surveys, these wealth surveys, and The last one they had was back in 2014. It was the fourth one, and they surveyed about 1,500 individuals, and they found out that wealthy individuals, that 69% of them were first-generation rich. They either came from poverty or from the middle class. And I my research kind of mirrored that a little bit. 31% of the self-made millionaires in my study came from poverty, and 45% came from the middle class. So there was only 24% in my study that I found that had inherited their money. That was one of the myths that I dispelled with my research.
Are they the leisure class, though? Maybe that was another one of the myths you dispelled, that they're a leisure class.
Yeah, there's nothing leisure about them, and that kind of dovetails into or segues into my next myth, which is rich people don't have to work hard. And I found in my research that they actually worked harder, meaning more hours each week than the poor in my study. 44% of the wealthy worked 11 hours more each week than the poor, and 86% of the wealthy who had full-time jobs worked 50 hours or more each week, whereas 57% of the poor who had full-time jobs worked less than 50 hours per week. And the Census Bureau data actually corroborates that. They actually studied, I guess, the inner cities, poor people in the inner cities, and they found that the top 20% of income earners in the U.S., which is really defined by the IRS, they worked 5 times as many hours as the average poor household. And you know that you might say, well, that doesn't mean that poor people don't work hard, and it doesn't. The real cause of it was single-parent households and high unemployment. I'm sure if the poor people could find jobs, they would, but it's just the nature of being poor. It's harder to gain employment when you're poor and uneducated.
Well, another of the points you made that I thought was really important was about failure. And the rich, the vision of the millionaires and billionaires is that they've been gliding along all this time.
Yeah, that's a really important facet to this. 24% of the self-made millionaires in my study had failed, meaning whatever business they were pursuing, if they failed and it went under. But they picked themselves up and they tried again. That's why they became self-made millionaires. They just didn't quit. They were persistent. I like to say they didn't quit on their dream. And so that's one of the number one characteristic that if I was going to number them, and I have over 300 data points on this, or habits, I would say the number one characteristic or attribute of wealthy people is that they're just persistent. They just don't quit. And I think that's one of the reasons why they're so successful in life. And what happens when you don't quit, when you persist, is eventually you get lucky. I call it opportunity luck. But because you're not quitting, you're in it every day, you're trying every day, eventually just the law of averages kicks in, and you get lucky. Your efforts and your habits, they start paying dividends in the form of opportunity luck. So that was another thing. The wealthy people actually create their own good luck just by being persistent.
You might hit 300, but you hit 0 if you never go into the batting cage. You might fail 70% of the time, but you hit nothing unless you get up to the plate.
That's right.
So let's talk a little bit about your study. A private reason for asking you, which is that I was a political scientist at one point. So I was educated in methods of social science research. And as a callow youth, I was more or less a Veblenite when it came to my regard for the wealthy. And us dirt poor graduate students often thought we should do a participant observer study of the wealthy, where you go into a community and live there and observe things and learn the attitudes and the operations within the community, really understand the sociological reality. And we could do that by getting a grant to live among the wealthy, drive their cars, live in their houses, go to their parties, date their women or men, as it were. Of course, we never did that. Is that what you did?
Yeah, in a way, I walked in the footsteps of the wealthy by virtue of what I call my 20-question list. It's really 144 questions that I grouped into 20 categories. And what I was trying to do, Chris, I was really trying to answer one question. What Why is it, what makes the wealthy wealthy and what makes the poor poor? What's the cause of wealth and poverty? And so this 144 questions that I used, I was trying to find out what wealthy people and poor people did from the minute that they put their feet on the floor in the morning to the minute that they put their head on the pillow at night. And I was really trying to understand all of their activities. So my questions were fairly broad, even though there's 144 of them. They were fairly broad. And the benefit of that was I got a lot of information, and I was able to then analyze all of that information, and summarize it into what I call my research summary, which is right now it's standing at 325 data points. But it keeps growing because I keep going back to my research, and I keep also doing additional research and uncovering other third-party information that relates to habits and wealth and success. So I really did take a walk in the footsteps of the wealthy and the poor over a 5-year period.
Okay, so how do we think about how people should go from becoming not rich to rich? What are the important changes that have to occur in an individual person's way of living?
Well, my conclusion in my research, which kind of shocked me, was that success or wealth creation is a byproduct of your habits. Now, that's an interesting conclusion because there's a lot of books written on success, and there were very few that are written about habits, the importance of habits. But I found that, at least in my opinion, it was your habits that dictate whether or not you're going to be rich or poor. So the first step in changing your life, if you're poor, is you've got to get a handle on your habits, and that means you have to become aware of them. Now, that might seem like a simple thing to do, but the fact is that 40%, according to a 2006 Duke study, 40% or more, they concluded in their study, of our behavior, thinking, and choices are habits. So that means, Chris, 40% of the time we're all on autopilot, whether we know it or not. We're doing things automatically, subconsciously, or unconsciously. And that's a great thing if the majority of your habits are good success habits. But it's a really bad thing if the majority of your habits are bad habits. And that's, talking about sociology, that's what's happening in the inner cities. We have what I call generational cycle of poverty occurring. And it's, the people that are to blame for it, I get a lot of negative feedback for saying this, but it is the truth. The parents are to blame. The parents, there was a study that was done on the habits that children pick up in life, and the conclusion of the study said that by age 9, children pick up most of their adult habits. Now, what happens during the time between 1 and 9? Well, for the most part, you're living at home. You're under the control of your parents, and you're watching everything they do. And there's some physiology behind that study that supports that study, and it's brain neurology. There's something called mirror neurons. They now know that children have an abundance of these neurons called mirror neurons. The purpose of mirror neurons is to help children emulate their parents. The idea or the theory goes that if children can emulate their parents, then they have a greater chance of surviving. If they follow what their parents are doing, they'll survive. The parents generally aren't going to do anything reckless and endanger themselves and their kids, so children pick up the habits from their parents. And if the parents have bad habits, which you have to admit that based on the number of poor people in society, it's somewhere close to 50 million people are living in poverty. These kids are picking up these habits from their parents, and unless they become aware of these habits, they're going to stick with them through their adult lives, and they're going to be scratching their heads and wondering, why am I poor and why am I struggling in life?
Although there is some upward income mobility, so it's not we're not totally programmed. Thank goodness we have some freedom in that regard. But I guess I would say that there is very highly considered warrant for your approach of habits. I mean, It was Aristotle who said habits become you, or you become habits. It goes back all the way to him focusing on habits. We have all these guides out there for investor behavior, things they're telling you to do as an investor, presumably to make you comfortable or wealthy or something. But it sounds like you would suggest that they read Ben Franklin or Parson Weems's biography of George Washington, or a McGuffey reader instead.
Yeah, I think George Washington's an interesting read because at the age of 16, he spent like a year writing down a list that I believe were called the virtues. I'm probably using the wrong terminology, but it was basically these virtues in life that you need to have in order to live a good life.
A very conscious exploration of the elements of the good life. Yes, I know what you're talking about.
And Benjamin Franklin spent a year and a half doing something similar. He was trying to find the right way to live, and so he wrote down a list of all of the things that you should do. I call them habits. He calls them by a different name. But there's some history behind this. It's not just that Tom Corley came out of the blue and said, "Oh, hey, guess what? He's the only one talking about habits." A lot of people in the past have kind of danced around it, and I guess I'm one who really just hit it on the head. But I think that these George Washingtons and Benjamin Franklins, and there are other individuals. Even Dale Carnegie talked a little bit about habits in his book, How to Win Friends and Influence People. So I think that there's a good, strong foundation that habits are what make the man or the woman. And so what I tried to do, Chris, was I tried just simply try and identify those habits that are lift you up, and those habits that tear you down.
And where can one find more information about your research and about these books?
Well, richhabits.net is my website, and it's really a repository of all of my research articles. Everything that I uncover in my research, I then turn into an article of some form. Sometimes they make their way into MSN or Business Insider or Success Magazine, and sometimes they don't, and they're just on my blog. So you can get all of that, my research data, on my blog. And also I have my books. You can buy my books anywhere, but my books are on my blog, and I have free ebooks that your listeners can download, and I have some free reports that they can download, and of course they can watch or read or listen to any of my media interviews. And I don't have all of them up there, but I have a good segment of them that are, I guess you'd call them national interviews. So they really get into some of the meat of what I'm talking about here.
Or take a look at your book, Rich Habits, The Daily Success Habits of Wealthy Individuals, which we have, perhaps not deeply enough, but placed within the context of some of the great thinkers of the distant past and some of the great thinkers of our founding generation and thereafter. Well, Mr. Corley, Tom Corley, richhabits.net, it's been a pleasure having you on the show.
Chris, thanks for inviting me on, and thanks for giving me the opportunity to share my research with you and your listeners. I appreciate it.
This has been Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Thank you for listening. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.